A question I'm asked all the time is, should I buy equity now or should I wait? Usually for a correction when equity is going to be cheaper. Now, you've probably heard the adage, it's time in the market that matters, not timing the market, which doesn't usually give you higher returns. But slightly controversially in this video, we are going to look at some of these market timing methods. And sometimes they do work, as we'll see historically. Now remember, if you do want to learn more about investing, or you want to learn more about economics, you can always sign up for our free weekly market roundup. There'll be a link in the description below me and above me. So let's look at whether it's best to buy now or later in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So what is it that drives the decision about whether to invest right now or whether we should wait? I spend a lot of time talking about investments with people, and often it's not anything specific which stops them from investing. They say things like, I've just got a feeling that markets are too high, or that there could be a sell-off just around the corner. You could summarize this as, I've got a feeling. One reason why that's a bad way to approach the decision whether to invest or not is that there's always a crisis around the corner or happening right now. This is a survey as part of the Financial Stability Report, which is done by the Federal Reserve in the US. And you can see that the survey participants at the moment are particularly worried about COVID, understandably. But as usual, there's a whole litany of other worries. And it's never the case that there isn't something that could go wrong. Of course, the global policy response could be inadequate, or the global corporate debt cycle could turn, or the US election could cause greater uncertainty. The list goes on. And I'm not saying that you should ignore those tail risks, but you should always think about the base rate. What's the most likely thing to happen? And most of the time in the past, everything has eventually turned out to be okay. The World Economic Forum has this nice way of approaching things where they plot it on a two-dimensional grid. Along the bottom here you can see the likelihood of a given event, with the most likely events on the right and the least likely events on the left, and then on the vertical scale we look at the impact if that event does happen. So the likelihood of the use of weapons of mass destruction is quite low, but if they were to be used it would have a very large impact. The kind of events we should be most concerned about are the ones which are both likely and which have a large impact. In this case it would be climate action failure or extreme weather. The blue boxes here are economic events, and there we should be most concerned about fiscal crises and asset bubbles according to this survey. Now this is one of my favourite graphs, and it's from Michael Batnick, who writes the Irrelevant Investor blog. And in it he's showing you all of the reasons why you should have sold equity over the last decade, while we've had this incredible equity rally. And it starts off just after the global financial crisis, when all of us thought the world was ending and there were huge numbers of job losses in the US. Then two of the largest US auto manufacturers filed for bankruptcy. We had the BP oil spill, the flash crash, the most powerful earthquake to ever hit. US debt got downgraded. And there was just a succession of really scary stuff. But if you had given in to your fears over this period of time, it would have been a mistake. Either because you were holding back investment as cash rather than investing it in equity, or because you'd put too much into bonds because you were scared that equity might sell off. So if you remember nothing else from this video, just remember that most of the time, everything is fine. And if you're investing for a long period of time, and here we're talking about decades, you should put as much into equity as you can and keep it there. Now, if we go back even further in time, about 50 years to 1970, the story's pretty much the same. And there were many, many crises over this period and some very large stock market sell-offs. But as long as you didn't sell your equity, you'd have achieved a very good outcome for most of the periods over this 50-year time span. So if you'd have invested $100 at the beginning of 1970, that would now be worth around $3,700 if you'd have invested in the US market, and a little bit less, about $2,700 if you'd have invested in a global index. Now you do have to worry about diversification because some markets don't perform well over long periods of time. So for example, if you'd have invested in the Italian equity market at the beginning of 1970, the returns would have been far lower. Your $100 would now only be worth about $280. The returns on the UK or Australia would have also been considerably less than they would in a global equity tracker. But generally, if you invest in a global equity index, you should expect a good outcome as long as you just hold that investment for a long period of time. So if general worries are a bad reason to hold back your money, how about if markets are overvalued? And are they overvalued right now? Fortunately, with equity, one way to value markets is to look at how many dollars you're paying for every dollar of profits. And that's called the price to earnings ratio. And here's its historical value for the US since 1950. So you can see at the height of the dot-com bubble, people were willing to pay a very large amount of money for every dollar of profit. Then after the global financial crisis, there was huge despair in the markets. And at that point, people were paying a lot less for every dollar of profit, which meant that equity valuations were very low. But by this measure at the moment, things are looking fairly pricey. And this graph is taken from currentmarketvaluation.com. You can get the latest version of it there. But it's always worthwhile looking at more than one valuation measure because they may tell you a different story if you look at markets in different ways. Now this one, which is also at currentmarketvaluation.com, it's called the Buffett indicator, and it tells you the size of the equity market relative to gross domestic product. That's the size of the US economy. And again, it was expensive in 2000. It was cheap just after the global financial crisis. And again, currently it's very expensive, even more so than if we look at price to earnings. Now you could say that the US exports to a global market, so what we should be comparing with here is the size of the US market relative to the global economy. But I suspect if we were to look at that, we'd also see that currently it's very expensive compared to history. Another measure that I often talk about is Robert Shiller's cyclically adjusted price to earnings ratio. So instead of looking at the earnings generated over the previous year, which would be the trailing price to earnings, or looking at the forecast 1 year ahead earnings, which would be the forward earnings, this divides by the earnings generated over the previous business cycle, which is roughly a period of 10 years. And it's been pretty good at picking up historically expensive periods. This was the huge rally we saw before the Great Depression. This was the dot-com bubble in 2000, and this was the equity market just before the global financial crisis, after which equity, according to this measure, became very cheap. But according to CAPE, currently markets are extremely expensive. Now what you'll notice if you look across these different valuation measures is that the ones which incorporate very low interest rates generally make markets look not so expensive. Whereas all of these other measures, such as the Buffett indicator or all of these flavors of price to earnings ratio, don't consider low interest rates and don't account for that. Aswath Damodaran produces this spreadsheet which he publishes on his website damodaran.com, which looks at something called equity risk premium, which is great because it gives you the expected return on stocks in the future. Now that's a combination of two things: the risk-free rate, which is the treasury bond rate, which of course at the moment is very low, and you can see its historic component in blue here, and then the second component is this equity risk premium, which at the moment is neither particularly large or small. But the expected return on stocks is at the lowest point it's been in the last 60 years. So while this strictly isn't a valuation measure, it does suggest you should temper your expectations about returns on equity in the years ahead. Now, Robert Shiller is well aware of the fact that you should adjust your valuation measures according to the very low rate of interest that we see at the moment. So he's come up with a new indicator, which is called the excess CAPE yield. Now, I've done a whole video about this for our Patreon supporters, and remember you can support us on Patreon and become part of our community, and then you'll get access to this video and many other member-only videos where we talk about questions which you've asked as part of the community, and you can ask questions of me or other members of the community via Slack anytime you like. It's a great way to learn about investing, and we all learn together. If you do want to learn more, there should be a link in the description below me, and there should be an icon you can click on as well next to me. So because we're taking the inverse of CAPE, when this value is now high, that means that equity is cheap. And when the excess CAPE yield is low, that means the S&P 500 is expensive. And if we look at the current value of the excess CAPE yield, it's pretty close to the median value, the typical value. And it doesn't show that the US equity market is hugely overpriced. So let's assume that the equity market is overpriced. What can you actually do about it? Well, Teddy, my dog here, is actually showing one of the alternatives, which is to do absolutely nothing. We've already seen that when you hold on to equity, even during periods when it's expensive, eventually it carries on rallying. You won't see such good returns when you buy when equity is expensive, but if you're continually investing as part of your lifetime savings, then you don't have a lot of choice about when you invest. And it's perfectly acceptable to simply carry on drip feeding your money into the equity market for your entire lifetime. But there's an interesting piece of research by Wade Pfau, and this article was called "Is a High CAPE Cause for Alarm?", where he talked about market timing, using CAPE as an indicator of when to buy more equity or less equity as part of your portfolio. So what he does is he actually creates these bands. So when equity is expensive in this high part of the graph, then you buy less equity. And when equity is cheap at the lower part of the graph, then you buy more equity as a percentage of your portfolio. For example, one of the rules he looked at, which he called the Graham and Dodd rule, so when equity is cheap down here, you'd have 75% equity, in the middle you'd have 50% equity, and when equity is most expensive, you'd only have 25% equity in your portfolio. Then he tracked this strategy over successive 30-year periods to see when that was better than just a 50-50 equity bond portfolio. So here are the results looking at those rolling 30-year periods. So for example, here in 1950, that period would be ending in 1950 but starting in 1920, and in that period you would have been better off market timing than having a fixed allocation. Now that's not always true. You can often see it's the case that the two are roughly neck and neck, and for the recent decades that you can see here on the right, it was better not to market time. But it's certainly not as clear-cut as some people would have you believe. There have been many periods in the past when it would have been better to use this kind of valuation approach to deciding how much equity to have in your portfolio. So I thought it would be interesting to use Shiller's excess CAPE yield to do a similar analysis. So again, we're going to look at 30-year rolling periods going back for over a century. And the way I approach this was the way many people invest, which is, let's say that you have $1 to invest every month. Every time you come to that investment decision, you ask a simple question. Is the S&P expensive as measured by the excess CAPE yield? If it is expensive, then we hold our money back from the equity market by investing it into a bond fund. Now eventually the S&P won't be expensive, it'll become cheap. If that is the case, then we put our $1 into the S&P 500, but we also sell all of our bonds and we buy the equity market now that it's cheap. So the size of our bond investment falls to zero. Now, of course, you need some kind of rule to tell you when the S&P 500 is cheap. And what we're going to use is a threshold relative to history. So that if we were in 1900, the threshold would have been at around 2. An excess yield below 2 at that point would have been expensive. But then as we learn more about excess CAPE yield over time, the cheap threshold would have increased. And currently the threshold which is cheap is just over 6. So here in the top panel, you can see the value of the S&P 500. If you'd have just invested into equity. And these vertical striped lines are the months when you would have held back your money from the equity market and invested it into that bond fund. And the reason why is that during those periods of time, the equity market was expensive according to the excess CAPE yield. So while it remained expensive, you built up your bond allocation, but then as soon as the ECY showed that equity was cheap, you sold all of your bond investment and moved it all into the equity market at those relatively low prices. But then you can see equity markets became expensive again according to this measure, and you carried on building up your bond fund. Then when equity became cheap, you moved all of your money out of bonds and into the equity market. And then for a very long period of time, equity wasn't considered expensive, and you'd have carried on building up your equity exposure. Then equity became expensive and you went back into bonds. So when we apply that over successive 30-year periods, going all the way back to the turn of the last century, the red line is if you invest in equity only. So you don't have any kind of fancy allocation rules, you just invest in equity. The blue line is what you get if you hold back using that 70th percentile as a threshold of expensiveness. And while there were sometimes examples when holding back helped, such as this period between 1950 and 1960, generally it's the case that it doesn't help. So it would have been better simply to invest in equity. Now I used a threshold of 70% to determine when equity was expensive or cheap, but we can try a whole range of different thresholds, going from 0, which means you always invest in equity, all the way up to 1, which means you always hold back and invest in the bond market. And if I look at the ratio of a simple equity portfolio compared to this holdback strategy, the typical value is always lower than it is when you simply invest in equity. There were some outliers when you have a 70% ratio here, and that was one of the examples we looked at, but generally it's the case that investing in equity and not playing around with the allocation will give you a better outcome most of the time. So there certainly were times in the past when it would have been beneficial to hold back your money because valuations were too high, but on average you'll be better off simply investing as much as you can in equity. And we keep on coming back to that conclusion because equity performance over a long period of time is so much better than it is for bonds. And remember that now you can also support us via YouTube directly. You can do that by clicking on the join button beneath this video if you're watching it via a browser, and there should also be a link in the description beneath me. But that way you get an icon next to your name, which looks great, and it lets us know in the comments that you're one of our supporters. Plus, if it's a YouTube live, we'll see that, again, you're one of our supporters. And that way we can remain independent. And, as always, thank you for listening.